Let's go, girls. Welcome to Talk Wealthy to Me. I'm Michelle Taylor, founder of Women in Wealth. From breaking money myths to building wealth and achieving financial freedom, we're here to empower you to create your own path. Talk Wealthy. Now, join the conversation and let's change the way women think and feel about money. Okay, ready? Hi, girls. Okay, so today you are just with me because we have a conversation on deck that is so important. And even if you don't realize how important it is yet, you will after we end the episode. Today, I want to talk about something that I'm sure many of you have heard bits and pieces of, but haven't gotten the full story on. And you know that I don't like that stuff. I want you to have all of the information, even if we're not quite ready to implement or you already have implemented it. This is how we change the narrative. I'm sure that many of you have heard terms like private equity and private credit, alternative investments, oil and gas, family offices. Maybe you know somebody that works with one. How people identify as an accredited investor and what that means. AI investing and how you can't be left behind because it's changing everything. Sounds like a lot of words, but no action items or no true understanding of what they mean. And if you've heard any of those things and identify with that, maybe you've also wondered what exactly wealthy people are doing differently than you are. And if I'm being honest, this can feel like there's two completely different conversations happening at the same time, and you're only hearing one side of those. And that probably doesn't feel great. Now, most conversations that people are hearing are centered around things like maxing out your 401k and contributing to your IRA, how you should buy index funds and stay diversified. And all of these are wonderful pieces of advice, but we've heard them. So what comes next? What are the next big conversations that we need to be having? Because rest assured, in boardrooms, investor groups, with private wealth managers, and among high net worth families on golf courses or in country clubs, the conversations are different. And the reality is that once people accumulate a good amount of wealth, the questions change. They're not asking, how do I make more money? They're asking, okay, now that I've done it, how am I protecting it? How am I reducing taxes or creating more income using assets that I've already built? How do I diversify beyond the stock market? And how do I actually create a legacy or generational wealth? And that's what we're going to talk about today. So one of the biggest misconceptions that I see, wealthy people are somehow investing in completely different things than everyone else. And they may or may not be, but the reality is they're still doing the foundational stuff that you're likely tired of hearing about. They are still in a position where they own stocks or bonds and they still have retirement accounts. But where they're making differences is they're adding additional layers to their portfolio and their strategy. And if you think about it this way, when you're building wealth, your portfolio maybe has a few rooms, right? But once you've actually started to accumulate wealth, now what you're building is an entire house. There are just simply more tools available and at a wealthy person's disposal. Let's start with the biggest shift that I'm seeing, and that's diversification. And it no longer means just simply owning large companies, small companies, international companies, and maybe some bonds. Today, many affluent investors are asking, okay, what happens if public markets struggle? What happens if high inflation returns? What happens if interest rates stay elevated? What impact does that have? What happens if the next big opportunity isn't publicly traded? Remember this, some of the largest wealth creation stories in history happened long before companies ever became publicly traded. Wealthy investors often want access to opportunities before they hit the stock exchange. Right now, everything is about AI and SpaceX, for example, they're getting ready to go on to the market, and that's great. But people are already investing, and it hasn't hit an IPO yet. How? When you're investing in things early, it doesn't mean that they're better opportunities necessarily. It just means that they're different opportunities and you need to think about them differently. One of the biggest areas attracting attention today is around private equity. Now, don't let that term intimidate you. Private equity just means that you're investing in companies that aren't yet publicly traded and maybe never will be. Instead of buying shares of a company on an exchange, investors are buying ownership interest in private businesses. And let me make this a bit simple. Imagine a successful manufacturing company and it's doing $20 million in annual revenue. It's profitable and it's growing, but it's not publicly traded. A private equity group may purchase part of this company to help it grow even bigger. If the company becomes more valuable over time, investors are going to benefit in that as well. And this is why many wealthy families like private equity. They like it because they're buying ownership, not just stock symbols or tickers that everybody knows about. Now, that doesn't mean private equity is perfect. It certainly comes with its own set of risks. These investments are often illiquid. Your money may be tied up for years, and the minimum investments are often a bit higher. The risks are also, or can be at least, significant. And that's why these opportunities are generally limited to accredited investors. But understanding the concept helps explain why affluent investors keep talking about it. Now, if you don't know what an accredited investor is, there's a lot of information and resources out there, but very simply, you need to make a certain amount of money each year over the course of the last few years, or have a net worth excluding what your home is worth that hits a certain limit. Basically, they have this in place to ensure that an investor, if something goes wrong, isn't going to be left in a position where they're, destitute. Now, let's also talk about another area getting enormous attention and something I talk about every single day with my clients, and that's around private credit. Honestly, 5 years ago, most people weren't talking too much about it. Now it's one of the hottest topics in wealth management. Private credit is essentially lending money outside of traditional banks. Think about this as a growing business. Maybe the owner doesn't want a traditional bank loan or might not have the ability to go out and get one quickly. Maybe they need flexible financing. Private lenders are then able to step in and provide capital. In exchange for this, investors may receive interest payments. One reason private credit becomes so popular is because many investors are looking for income. That is something that you've heard me reference quite a bit. You want to create mailbox money or passive income. So money coming in outside of what you're getting for whatever you're doing as a job or a career or business owner. They like the idea of generating cash flow rather than just relying entirely on stock appreciation. Again, it doesn't mean that this is any better or worse. It's just different. But it's one reason the conversation has totally shifted. Creating that mailbox money is part of most affluent people's wealth plans. Now, let's talk about something I hear a lot of people talking about, and it's probably because of shows like Landman, which is fantastic, by the way, if you haven't seen it, but it's all about oil and gas. And whenever oil and gas comes up, people immediately assume it's either amazing or terrible. The reality is, it's much more nuanced than that. Many wealthy investors look at oil and gas for 3 primary reasons. 1, potential income. 2, diversification. 3, tax benefits. And this is one of those things that can check all of those boxes at the same time. So let me give you an example. Suppose that you invest in oil and gas, and if the project is successful, there's a very likely chance that there will be an income distribution from production. In some situations, there may also be an amazing tax deduction associated with drilling expenses. Now, this is not a blanketed recommendation. It has to be a good fit for you as an investor. And not every oil and gas project out there is good. In fact, there are plenty of poor opportunities in this space. But this is why wealthy investors continue to pay attention here. They're often looking at the total picture: income, tax efficiency, and diversification. They're also able to take the emotion out of it. This isn't whether you think oil and gas and the way that we fuel our cars or most of the world lives their lives on natural gases and resources is good or bad. It can be hard, right? But you want to take the emotion out of it and look at what this can do as a tool in your toolbox. And here's an important lesson. Wealthy investors don't necessarily invest in oil because they think it's going to double. Sometimes they're simply trying to build a portfolio where different assets behave differently. And that's what I mean around true diversification. If one sector of the market is not doing great and one sector is, if you're diversified, you're winning. And that is going to give you the kind of peace that only diversification can deliver. Okay, so let's talk about real estate, because real estate is still one of the most common wealth building tools among affluent families. And really, I think you'd be hard pressed to find anybody that you would identify as a well-known wealthy person that doesn't have this as part of their portfolio. Now, with that being said, this conversation has certainly evolved. 5 years ago, everybody wanted rental properties. Today, investors are asking deeper questions. Should I own this directly? Should I use syndications? Or should I invest through funds? Should I use a Delaware statutory trust or 1031 exchanges? Or is it more about income or growth or tax benefits? Again, the conversation becomes more sophisticated as wealth grows and certainly more nuanced. Finding somebody that's an expert in these fields certainly helps guarantee your success because you're going after the most suitable outcome. One thing wealthy investors understand is that no matter what, tax matters, like a lot. Imagine two investors, both earn 10%, one keeps 8, one keeps 6. Over decades, that difference becomes enormous, which is why tax strategy becomes increasingly important as wealth grows. Not tax evasion, tax planning, and there is a huge difference. And I hate to break it to you guys, but it's, a common thing to say, look at this wealthy person who's not paying taxes. Don't hate the player, hate the game. The IRS gives everybody the same playbook. Understanding how to play in those sandboxes is where you're going to see a big difference. This same point is also why many wealthy families eventually create entities that help organize their assets. You've heard me reference holding companies or family partnerships, trust structures, asset protection strategies. Now, these are not exciting topics. In fact, they can be rather boring, but they are so important to understand because they often have a bigger impact on long-term wealth than just picking the next hot stock that everyone's talking about. Okay, so let's talk about something that sounds super intimidating, but actually very simple. You may have heard others reference working with a family office. People hear that term and assume it's only for billionaires, but it's not. The concept is actually very straightforward. A family office is essentially a team helping manage wealth. Now, you don't have to work with a family office. You can work with a group that operates in a similar way. And that's really just giving your money and wealth planning strategy a CEO approach. Instead of one advisor handling everything, there's maybe a lot of different professionals weighing in on your situation, and that is going to be incredibly valuable. We're talking about estate planning, investments, insurance professionals, business consultants, a CPA, tax strategy. Everyone is working together for the greater good, if you will. Most of you listening may not be at a point where you need a formal family office, but they absolutely are something that you need to kind of copy or implement with your own approach regarding your finances. Think about it a little bit more holistically instead of everybody operating in a silo. The big takeaway here is I want you to stop managing your finances like a consumer and start managing them like a CEO. Once you can make that mental shift, you'll see a lot of things change for the good. The wealthiest families out there are rarely making financial decisions in isolation. They're coordinating decisions, they're talking to professionals, they are coordinating everything, the investment strategy, making sure that it impacts taxes, and then taxes impact estate planning. Estate planning impacts business succession. Everything works together in synchronicity. Okay, I don't think anybody can turn on the radio or social media or the TV without hearing about AI. And really, this is an important thing for us to talk about. No conversation nowadays about investing is complete without it. Whether you like it or you hate it, it is not going anywhere. Most people think AI investing means buying technology stocks, but many sophisticated investors are looking deeper here. They're looking at infrastructure, data centers, power generation, semiconductors, energy demand, cloud computing, cybersecurity. And if you, like me, don't even understand what a lot of those things mean, don't beat yourself up. You just have to do some research because it truly is like learning an entirely different language. But they're not just asking, what AI company should I buy or cryptocurrency. They're asking what businesses are benefiting most because AI exists. And you see what I mean about asking different questions, right? So, for example, every AI model requires an enormous amount of computing power. Computing power requires data centers. Data centers require electricity. Electricity is what is going to run infrastructure, and that requires capital. So suddenly the investment opportunity may not be the AI company itself, but maybe everything that's supporting it. This brings us to another major shift. Wealthy investors are increasingly thinking about ecosystems and not just headlines. They want to understand what sits behind the trend to really understand what's driving it. Another conversation happening right now is around liquidity. And why is that so important? Because many wealthy investors intentionally maintain significant cash reserves. Now, by me saying this, it doesn't mean that I'm changing my stance on that. What I mean is people are keeping cash reserves handy because they want to be able to jump on the next big opportunity. And really, the only way to do that is by having access to capital. Cash provides options, it provides flexibility, and it allows investors to act when those opportunities arise. It also, of course, reduces stress and it makes you sleep well at night. But the key is having enough be there to give you that sense of calmness and to allow you to jump on opportunities as they arise, but not leaving it just sitting in a savings account or in a safety deposit box or a safe. Put it to work. One thing that I wish more women understood, in fact, is that wealthy investors aren't necessarily taking more risk. Certainly, there's a lot that are. But in many cases, they're actually just trying to reduce the risk. The media will portray wealthy people as constantly chasing these big, huge returns. But in reality, many affluent families are focused on preservation. And their mind shift has happened to allow them to say, how much can I keep instead of just how much can I make? And that's a huge difference. And honestly, it's one of the most important mindset shifts that happen in wealth building. Eventually, wealth creation becomes less about earning more and more about stewardship. So, what can you take away from all of this? You don't need millions of dollars. You don't need private equity tomorrow. You don't need oil and gas today. You don't need any of these things immediately. But what you do need is to understand how the conversation evolves as wealth grows. Because if your goal is generational wealth, the conversations you're asking today should eventually become more sophisticated. You should outgrow the conversations and the questions and the strategies that you've implemented. And that doesn't mean that they're bad today, but they're not going to get you to the next level unless they evolve. So start thinking about things like, how do I invest money? How do I keep money? How do I protect my money? And then how do I transfer that money? That's true progression. And maybe the biggest lesson in all of this is this. Wealthy people aren't playing a completely different game. They're simply playing a longer game. They're thinking beyond this quarter, beyond this year, beyond themselves. They're thinking about income, taxes, risk, legacy, opportunity, ownership, and family. And that is exactly why they're investing differently today than they were 5 years ago. I know this was a lot, and you may have a lot of questions. And I love questions around here because if you're brave enough to ask the question, I guarantee you there's 10 people around you that have the same one and didn't raise their hand. So feel free to send me a DM or drop a question in the comments and I'll answer it. And then you can give that answer to the people that need it as much as you do. Change the conversation, change the way you're thinking. That is how we move the needle. As always, thank you for spending a little bit of time with me here. And until next time, let's keep changing the way women think and feel about money together.